bring on board Dharmesh Kant as well, Head Equity Research, Chola Securities, joining us this morning. Dharmesh, I want to quickly mark out commodities, and within that basket, really the focus is on pretty much all of them. You look at how copper has performed, 2% down yesterday, 2% down today overnight as well. Spot aluminium is down 4% today. You're seeing Brent, which is sub 74, of course. But that apart, you're seeing silver as well come off those highs, now at $57 an ounce. Headwinds evident, at least from a commodity standpoint, in your opinion, and commodity stocks, they've also come off the highs. How much more?
Yeah, very good morning to you and to all our viewers. See, back commodity as a asset class is always like this. Whenever the upside is there, it continues in the upside for 1 or 2 years. So major part of the big upcycle we have seen through, and normally then it corrects and consolidates for a meaningful period of time. So these were, I mean, the base metal prices or the bullion prices were there in the futures market. As far as spot is concerned, there has always been a price differential between the two, and the gap was significant. So spot prices have not corrected that much as the future prices have corrected. Point number one is that. Second, the global demand on the consumption side is likely to improve from here on rather than deteriorate. So with things resolving and sorting out, you will have better demand for aluminum pickup or copper pickup or zinc and the likes. At the same time, silver demand has an industrial connotation to it, be it electric vehicles or the electrification and all the electronic components, mobile phone, everything is using silver, and is likely to compound at 15 to 17% CAGR going forward, with primary driver being renewable energy resources. All the solar panels, they use silver wiring. So that will be there. Having said that, I think this is a good opportunity to accumulate your good quality commodity stocks. And maybe one can look at Hindalco or a Vedanta Limited and JSW Steel for that matter, because from here on, not only Middle East, but India itself, the infra activity is going to pick up. So we are a buyer in this decline, and I do still believe that at least 1.5 year of upcycle, as far as the futures prices are concerned, they may be retesting the recent highs, and the demand is likely to get the spot prices higher going forward in next 1 to 2 years.
Interesting. Dharmesh, hi, morning. So you think all the positives are in the price, or do you think that move is yet to come because of the significant cool-off to begin with in crude itself?
Yeah, good morning, Aisha. I mean, as far as crude cool-off is concerned, I was of the firm opinion a few weeks back that all this derivative position in the futures market will unwind, and it will have an impact of crude prices going below from where it started, which has happened today as we speak. And the positives of that is definitely in the price, because 1 quarter of impact will be there. Q1, we will see the impact on the operating margins. But the good part is, if you look at from the other angle, from the macro wind which is likely to flow. First is the US tariff thing, which was haunting us last year. It's out of the window. We have to deal with much lesser tariff, maybe 10% or 11%. So that's already there in the price. Whatever input price hike was there, most of the companies have taken substantial price hikes, negating almost 80 to 85% of the input cost pressure. So what happens in this cool off Q2 and Q3? You will have the benefit of lower input cost, but price rollbacks never happen. So normally you go with the same price. So that will take care of the good profitability in the second half of this year. Having that in regard, I think we are in a sweet spot. Market can see a good slow build up on the upside as the numbers come by of Q1, and then management commentaries will give you a detail on the Q2, which I think will be far positive than what it sounded a couple of quarters back. Only caveat here is the El Nino impact, how monsoon. So in monsoon, if you say 10 to 15% kind of a drawdown is from the LPA is already discounted in the price, and people are working with that. Our ground check does suggest there has been no let up in any form whatsoever, be it consumer consumption or the demand on the credit side or the collection side. The collections has been very easy. There is no hardship on the collection. That is the first indicator where some hardship in the economy is being felt. So, but that's working very fine. Credit growth, just quarter itself will be 17, 18% on an average basis. So all these indicators do point that one has to be a bit bold, but this is a time to go for cherry picking.
Right.
Dharmesh, one other sector which has seen some activity in the last few days is the defense pack. How do you look at BL and BDL?
Yeah, BDL, we have not been that much constructive, but BEL and HAL, we have been constructive throughout. And Majgaon Dock from the steel building space. So, I mean, as far as order book is concerned, no changes out there. It has been into some sort of a news flows surrounding that. Yesterday, some news was floating around HL that FG 414 engines may be priced. I mean, they will get it at a higher price from the vendor, and that is the clarification is still awaited on that. Because of that, we saw some sharp correction happening. And secondly, what happens is there's been too much trading allocation also into the defense pack, sensing the volatility in the market. So whenever the market improves, you have that shift of money, that hot money rolling out of the defense pack from trading and going into more aggressive, maybe the entire NBFC and banking place. So that rotation will definitely take a hit. But the sticky nature of the investors, those who have invested in the defense pack are continuing. And to our mind, I mean, it's a no-brainer if you are looking from 3 years perspective. Both HAL, BL, and Majgaon Dock. Majgaon Dock, that P-75 submarine deal, whenever it happens, it will be unlock a very big opportunity from them. Almost 1 lakh crore of opportunity is there. That's Majgaon Dock now has a 23,000 crores of order book. The JV would be 50-50%, so 50,000 crores of additional order book will come into flow, and it will put it into a different orbit altogether. So all defense companies are maturing into a different orbit where they will be more of a OEM supplier with higher margins going forward into the future. So these corrections are basically for investors. It's a delight. You can lap it at lower levels for a much better, higher upsides going forward.
Dharmesh, let me take a pause on that. Dharmesh, wonder if you have a view with regard to a Sterlite in particular and the AI play in India, right? How exactly does one play it at this point of time?
Yeah, it's just very difficult to, pinpoint the AI play in India because everybody and anybody who's associated with some form of a data center or AI play, it may be a normal business for them. End of the day, you're supplying cables and cables can be supplied to anybody where it is meant to be used. So, but the connotation of AI play itself, gives a different color and picture to that. Stellar technology per se, I have been tracking it for quite some time. You do get, volatile up moves in between, but the erratic nature of the earnings. So basically, say it's a commodity business. End of the day, there is no technology being used in whatever they manufacture, and there is no IP or mode to that business. That's the problem with that. Order book is strong, but more of a trading play it has been last 10-15 years. So we are staying away from the fundamental call. Technical calls are always there on.
Interesting. Okay, that's the word coming in on Sterlite Technologies. The other set of names that you may want to look out for is the entire OMC, paint, tire stocks, aviation. Of course, Interglobe Aviation has already run up quite a fair bit. But the rest of the pack, your OMCs, paint, tire companies, you may want to look out for that. Dharmesh, what's the crude sensitive trade that you're liking best right now?
Yeah, I mean, the best part is the BFSI space, the entire banking, though it's an indirect play because of the macroeconomic headwind is now turning into a tailwind. So that remains there. As far as paints and tire companies are concerned, we're not very aggressive on that. Paint has already seen a fair bit of rallies from the bottom. And I think fundamentally the valuations are still very expensive. The competition is here to stay. And when we walk into the festive season, we will see the pain of the competition playing out again in the paint space. So but to my mind, 5-10% kind of pop-off can still be there, but not that great. Tire companies, the fundamental catch is second half of this year is having a high base effect of 20% kind of an OEM growth on an average last year. So from after GST rollout cut from October to March, we would be seeing a high base effect of the sales. So how much better they do? They are already guiding for 9-10% kind of a volume growth on the two-wheeler side and 6 to 7% on the four-wheeler side. So that's the industry guidance. I think they would be close to it. If they do that, it would be beneficial for them. But ancillaries and auto space should be avoided as of now. Other than that, to my mind, it's more to do with indirect plays through the banking space.
Ancillary and OEMs completely stay out. That's Dharmesh. Is that the call coming in from Chola?
Yeah, definitely. Yes. I mean, if you are looking for a 1 or 2 year kind of a perspective, the price, though the price correction has happened in most of them after the surge which we have seen, but going forward, because of the high base of last year, they would find it difficult to deliver that 20-25% kind of growth on the profitability side. So that is the call we have taken. So it's a tactical call right now to stay away, and maybe at lower levels a fundamental buy call can be taken, but we would like to wait at least 1 quarter more before taking that call.
Kunal, you were talking about the Nifty moving 1,000 points from here. But what happens to the broader market, which in any case has been outperforming? Does that move up ahead, or do you see a change in the trade or a drift in the trade?
So the change which I would sense is that from being in very outperforming kind of a mode, they would come back into a slight outperforming mode over here because the large cap names are making a comeback for themselves. So it was just to put it more simply on a statistically basis, if the Nifty moved up by 100 points, the mid caps and the small caps, they moved by 150 to 200 points. And the large caps underperformed by 50 points, 70 points approximately. But now it could be a different texture altogether, where the large caps would probably try and cover up the underperformance, maybe move at par with the indices or slightly above those levels. And when you see that kind of a tone, the mid caps and small caps, they generally take a bit of a cool off or a consolidative mode, so that the very high beta move for these mid caps and small caps, that typically narrows down when you look at this broadly over the span of the next 2 weeks, 3 weeks per se. But then this also opens up, the better themes in terms of sectoral up moves. Over the last many weeks, when we've seen the prices moving up higher, we've seen very individualistic stocks from the sectors showing signs of strength. When the mid caps, when the market goes into a confidence mode or a high confidence mode, the number of stocks which lag from the indices, those number of stocks they reduce, and you see more participation across the market breadth, both in terms of the mid caps, small caps, and the large caps making a comeback. So net result, of course, will be positive for the mid caps and small caps. But I would just sense that maybe the large caps, which were lagging behind, they could make that slight extra bit of alpha in this leg of up move.
Okay, on that note, let's take a very quick break. When we come back, we'll do exactly that, figure out where the alpha generation within mid and small caps can happen.
He's Chief Manager, Technical and Derivative Research at Angel One. Osho, the eternal debate, private versus PSU banks, where should one sit at this point of time with regard to that? And what do you make of the move yesterday, at least the sharper up move in private sector banks?
Very good morning, Harsh. Firstly, thank you for having me at the show. Well, yes, no doubt we have seen very strong recovery in last trading session, and specifically it was based on the back of private sector banks and NBFC. So I'm expecting the same move to be continued because major of the counters are still looking very positive on the technical front. So I'm expecting that in the coming session or in today's trading session, there might be a possibility of a further continuation on the higher end. But both the key indices, firstly, which I want to highlight, are near the resistance zone. Nifty is again at a resistance levels of 24,100, 150 is a very strong resistance level. And once we open around 70 or 50 odd points on with a gap up, then we might see some kind of resilience on the higher end or resistance on the higher end. Same thing with Bank Nifty as well. So initially, I would advise to stay focused on the stock specific front rather than index. But stock specific front, I'm having quite bullish approach and expecting some decent movement in some of the banking counters. Now coming to Eternal story, then Eternal is technically is looking quite decent. It is into a consolidation zone, not very much correction or neither a breakout in the counter. But I'm expecting that in the coming period, if there will be a decisive and sustained movement beyond the zone of 265 or 268, then we can see continued momentum. Else, till that time, better to stay sidelines. Looking at the recent tractions or recent developments, I'm expecting some kind of correction towards 245, 240 odd levels. But again, those can be seen as buying opportunity, but that will be early to say. For now, better to stay sidelines from the count.
Okay, let me come straight back to you, Dharmesh. Give us a sense. IRFC, that OFS is not fully subscribed, is one of the few where the green shoe option is not fully exercised by the government. The stock trades at 2 times book, does I think 1.3, 1.4 times, 1.3, 1.4% in terms of ROA. How should one look at the counter? There'll still be likely some bit of selling because minimum public shareholding to be met.
Yeah, see, I mean, it's an avoid for us, definitely. I mean, there can be selling and there can be a flow to that. And from there, the point is whether how the stock recovers or the buildup is there, to which we suspect that. The reason being last 2 years, railway spending has not been that great. This year, so far, they have been doing quite well. I think 1/3 has already been spent in a 3 months time frame and likely to surpass 293,000 crores of allocation in the budget. So IRFC would be a beneficiary of that. But there are far better plays in the entire NBFC space. I mean, renewable power space where IREDA is there, which has done phenomenal numbers last year. If you look at quarter on quarter and all the quarterly numbers, and it's trading at after such a sharp correction, it's trading a quite valuation discount. So I think companies like IREDA should be looked into, which is into renewable power segment, and railway companies still should be avoided as far as finance is concerned.
Okay, Dharmesh, very quickly, positive with regard to real estate as a pack.
Yeah, we are constructive on real estate as a pack. I think last leg of a good rally is still pending, and there are many good companies, good rollouts, GDP rollouts are there, which is likely to be monetized in FY 27 28. So we are working on a couple of them. Very shortly, initiating coverage will be there on some of them.
Wow, interesting. Some initiating coverage notes. We'll probably call you then, Dharmesh, and try and get a perspective of how you're seeing the space as a whole. Thanks so much, Though, for coming
Thank
in
you
and
so
speaking
much.
to us. All right. Let me quickly start taking stocks, because there will be buzzers in trade today, very, very likely. Osho, within the metals pack, any top picks? How would you play it?
From the metal counters, some of the counters are looking decent to me. There has been a decent correction in the last couple of trading sessions, but again, majority of the counters are still hovering below this, hovering near the support level. So better to wait for some kind of consolidation in major of the counters like JSW Steel is having a very strong support around the zone of 1220, 1215 odd levels. If there will be any kind of correction or any kind of consolidation around those levels, then that might witness some kind of positive traction. Tata Steel again is at its 200 the simple moving average. So I'm expecting that 185, 184 should be seen as a very strong support levels. And the correction in the last two trading sessions have given a very strong movement in for the short term or for the shorting period. So that means on the sell side. So I'm expecting majority of the counters can be seen as opportunity, that any kind of movement, any kind of rise on the higher end should not be seen as a buying opportunity, but wait for some consolidation again for 1 to 2 trading session and then may look for buying opportunity.
Okay, wait for a couple of sessions. Sure, let me take your view with regard to cement as a pack and Dalmia Bharat in particular, that upgrade coming in from Goldman. How should one look at the pack and Dalmia?
See, overall, the counter or the whole sector is looking quite okay to me. It's not very much aggressive or very much bullish on the major of the counters as of now, but some of the counters are showcasing some kind of potential for bullish reversal. Ultratech Cement will be the preferred pick from here onwards because the counter has seen a decent recovery from the zone of nearly 10,800 and is now on the verge of giving a consolidation breakout. So for short-term perspective, I expect Ultratech Cement can see some kind of positive traction, again 11,900 to 12,000 will be the first target for the counter. Now coming to Dalmia Bharat, this counter has seen a consolidation. It's not very positive movement in the recent period, but again, the counter has seen a decent traction in the recent scenario. So I'm expecting that overall there might be possibility of a decent momentum in coming period, but not very much bullish as of now on the chart structure, but overall I'm expecting that in coming period, if it breaches the zone of 1800, 1820, which is the previous swing high, then from there onwards we can see decisive uptrend in the counter. But as of now, momentum play or technical pullback can be seen, obviously on the back of positive developments on the fundamental aspect as well, and also the counter is into a consolidation zone. So there might be a technical pullback, but 1800, 1820 is a very strong resistance level. Any breakthrough above these levels can give some kind of positive traction in the counter.
Okay. Kunal, very quickly, REC, PFC, IREDA, some of those names, and because the NBFC upper layer norms were finalized, you could well see some traction on those. How are they looking like on charts? I mean, some of the move is already done, by the way, is what it seems like, at least based on the moves. But your take?
See, I think out of the three names, PFC, of course, is one of the most strongest one because the stock is trading above the long-term average by a margin of 10% broadly from 400 levels is where the 200 DMA, the stock is at 437, 440 mark, where it closed yesterday. RSC is just marginally below its long-term moving averages, and IREDA, of course, is struggling to trade even closer to the 50 DMA. So in terms of price relative strength, PFC is the one which is more stronger ones. IREDA is a very volatile stock. The stock just last week or so was almost at 134, 136 mark. And in the last couple of days when this correction happened, the stock came down towards 124 kind of a mark. So the propensity of the stocks to go into a sudden 10% correction makes the stock a little bit more volatile, which is not the case with the likes of PFC, RSC.
Okay, that's the take coming in on some of those. That's a bio and ICICI Bank. Osho, what are your first observations on how we've kickstarted trade in any individual stock ideas?
See, again, the private sector banks are looking quite decent to me. There has been positive developments. Axis Bank, Kotak Bank, these two will be the preferred pick from the private sector. Axis Bank has given a very strong flat pattern movement in yesterday's session. Today, there is a strong follow-up bank. So I'm expecting the move can be continued on the higher end. So 1430 will be the immediate target. And on the lower end, 1355 will be advisable stop loss. Other counter from private sector bank is from the realty space. Godrej Properties is looking very positive to me. It has gained near about 1.4% in today's trading session, and it has given a very strong momentum as well from the last trading session. So I'm expecting this counter can also see some positive traction throughout the day. So 1865 followed by 1880 will be the targets on the higher end, while on the lower side 1815 will be the advisable stop loss for the short-term trade.
Interesting. Okay, Osho, great to have you on the show. Thanks for your time. And Kunal, we'll see you